Hey everyone, my name's Andy. My channel's Finding Value. If you like and want to learn more about a commodity supercycle that's coming, this channel's for you. Click subscribe, click the thumbs up button if you like this content here. I'm going to answer to a comment that was left in the comment section that I think is very important because a lot of what we talk about hinges on real estate. Real estate really is what we'll call it supplies the money for inflation, and it also can crash the economy. It'll crash the stock market and the housing market. Everything will implode because it's deflationary when real estate does poorly. So there's something I really want to answer here. Someone made the comment, the primary way to bring down the housing market is by increasing interest rates, which will cascade into increasing mortgage rates. That is false. And it's not an attack on anyone. I want to make sure everyone gets this extremely clear because it's very confusing if you're looking at the world through that set of eyes. Housing goes up and down based off supply and demand only. And I'm going to describe to you how that works. So first, I'll say interest rates, they chase inflation. So when house prices go up, commercial banks lend that money. 50% of lending from commercial banks, 50% of lending that commercial banks do for lending goes into residential real estate. So that's 50% of their, we'll call it, lending book. Real estate, when it goes up, it gives a signal that there's a supply-demand balance problem. When there's a deficit, when there's not enough new homes being built, what happens is the real estate market goes up. Now, in that scenario there, interest rates mean absolutely nothing. It's a supply-demand imbalance. What happens is if you don't have enough new homes, you've got a whole bunch of people starting to bid after the existing homes, getting into bidding wars against homes. That's what drives all of these prices far higher. And we're in that scenario right now with a 3.8 to 4 million home shortfall because we're not building enough new homes. And we had massive problems in the mid to late 2000s bubble with all the foreclosures coming out. It screwed up the housing market. It put us into a situation where we are short homes. Now, interest rates have nothing to do with this shortage. Nothing. If interest rates rise, it doesn't fix the shortfall problem. It's a supply-demand new house problem, new housing build. So the only thing that's going to be able to fix this is if we build more new homes. Now, people on YouTube, they like to really confuse you. I heard this from a lot of other YouTube channels. The channels say that interest rates are what is driving house prices higher. That is false. That is completely false. Erase it out of your mind right now, please. Please, please, please. Now, I have something here. There's some data here. I'm going to pull this up. This is a 30-year fixed rate mortgage. I just want to make my point. In the 1970s, we had a demographic that came through known as the baby boomers who were in prime buying years for homes. And during that time frame, home prices shot up tremendously in some areas of the nation. In California, home prices, I think it was from mid-70s to 1980-ish. Somewhere, or 1979, somewhere in that range. It went up tenfold in some areas. 10 times. And look what interest rates did. During that same period, they went from 9% to 18%. What does that mean? It means that inflation came from housing, and it meant that interest rates chased inflation. Interest rates is basically trying to balance out the supply and demand of loans. if that makes sense. The higher the demand for loans and the higher the inflation, because remember, more loans equals inflation. Keep that in mind. New homes being built means more loans, which means higher interest rates. The driver is the shortage of housing. Interest rates is a symptom of house prices going higher and more loans coming into the system. It's that twofold thing. Interest rates didn't drive the shortages of homes. Does that make sense? Now, what really drives Treasury bonds to go higher and mortgage rates and whatnot, which will follow, is that inflation is higher than the interest being paid on Treasury bonds. So people sell Treasury bonds and invest their money differently. This selling of bonds must raise rates to attract new investors to buy bonds. That's what QE quantitative easing is doing, is that they're buying bonds to suppress rates down. If we were in a deflation, we wouldn't need QE. And that's where the deflationists are all wrong. Commercial banks have to buy bonds to keep the rates low. Or the Federal Reserve buys them. They all have to buy them. Commercial banks and the Federal Reserve they're one entity. They own each other. So you can't use data from a commercial bank and say, oh, look, they're buying it. Well, they are the Federal Reserve. They are owners of it. So in this chart, the biggest boom, well, it might have been it's the first or second biggest boom in American history. Interest rates went from 9% to 18%, and house prices went up 10 times. So the interest rate driving home prices higher is false. Just throw that in the garbage, please. For me, do it. It is just flat out wrong if you look at history. Another big boom was in the 1920s. Housing crashed before. They had a huge housing boom, and then it crashed in the 30s. You know, the 29 crash, that also was a real estate boom, and that's what really blew everything up. So I wanted everyone to understand that interest rates is not a driver. It is literally just a symptom of what happens when you have inflation. Interest rates go higher because you have more inflation, and there's all these things that people do that react to the inflation. So that's one thing I just want to get cleared so everyone understands that interest rates has no bearing on the housing market. It is supply and demand. And we should have higher interest rates right now. The market wants it, but they're going to buy it and suppress it down with QE. So why are they doing this? It's because they have to hold up and prop up dead companies that all should be going bankrupt. They're propping up stocks, they're propping up bonds, they're propping up all of these things which need interest rates to be low, because if they were to rise, people would exit those things. They would exit bonds, they would exit stocks, and they would run into inflation-protected assets. That's why they're doing it. This is Finding Value. If you like this content, subscribe, click the thumbs up button. Thank you.